Here's a fun fact. Over the history of time, Manhattan property values have always gone up. While the market does ebb and flow, if you look at the charts, ever since the inception of whenever the records were taking, property values over time have always gone up. Today on Managing Manhattan, we have an exciting episode. We're going to talk about the current state of the investment market, and we may or may not give some future predictions about what to look out for in the years ahead. I have two great guests with us today. Our first guest is Takk Yamaguchi. He is the founder of the Takk Team at Compass. He has done more than 1,800 transactions in his career and is ranked in the top 1.5% of brokers nationwide, according to Real Trends. He's actually the father of a 20-month-old baby, 15-month-old?
15 month.
15 month. Great. Welcome to the show, Takk.
Thank you.
Great to have you. We also have with us Brandon Polakoff. Brandon is a principal and head of New York City investment sales for the esteemed firm Avison Young. He was Commercial Observer Top 30 Under 30, and he's also a top producer at Avison Young from years 2018 to 2025. He was born in New Jersey and is the father of two twin boys.
That is correct.
So basically, we're all just tired dads on today's episode.
Yeah, exactly.
I've got 3 kids. You've got 2. You've got 1. Hopefully more coming.
You've got the hardest job out of all of us, though.
Oh, you guys just wait, because when those boys start to grow up, everything you own will be either ripped, stained, or broken.
Done.
Perfect.
Yeah,
Great.
it's really quite a dream, and you will never be more tired than you are in your entire life, or sick, by the way. We're always sick because
great.
those kids love to act as petri dishes
There we
for
go.
illness. So I'm excited about today's episode because we're going to have 2 very distinct perspectives on the market. We got Takk on the residential side. We got Brandon on the commercial side. So I look forward to a lively conversation about what's happening in the investment market today. Personally, as an eternal optimist, I'm a big believer in New York City. And we're also going to talk about all the residential happenings and what's going on in that particular market. So Brandon, I'll start with you. Who's buying in today's market? So, I know that New York City is a very heavily driven foreign, investment market, especially back in the mid-2000 teens where we had a lot of Asian investment. Which country do you see most prevalent in the, investment market here in the city?
Unquestionably, Japan.
Japan.
Japan is dominating the space now. So, if you go back 10 years ago, you would see investment from Canada, Germany, Japan, China, as you know, because you represented a few people from China, you name it. And today, I would say 90% of the foreign investment's coming from Japan. You might then ask why.
I was going to ask why.
Yeah,
I'm glad we have Takk here also. As a native-born guy from Tokyo, he can help also answer this. But let's hear your perspective on why is it that the Japanese are buying?
There's a few reasons. The first is if you look at where values are today versus where they were 10 years ago, they see the opportunity. The second thing would be rates there. So the rate of return in Japan for, let's say, comparing to the U.S. Treasury, it's about 0%. So there's no return on your money there. A big one, though, that no one really talks about, but it's depreciation. So there's certain depreciation benefits that buyers from Japan buying in New York City or the U.S. on a whole can get, particularly when buildings are wood framed. It's more nuanced than that, but there's huge depreciation benefits. So not only are they getting the benefits of the yield, they're also getting the depreciation benefits.
And Takk, elaborate on this. You deal with a lot of Japanese clients. I have some of your Japanese investment clients. Like why? And I see this as well in our business. Most of the investment calls I'm getting are from Japanese clients. Why?
Yeah, so it's interesting. The way the tax laws were written in Japan, they actually value older properties. And in Japan, historically, real estate properties don't go up. Yes, of course, you got pockets of Roppongi and Shinjuku and Tokyo, where I'm sure you've been to, and kind of nice, very coastal. Yeah, they're fun. But if that's really just 0.1% of Japan in terms of land mass, and historically, older homes never really had any appreciation in value. I think primarily a factor of 2 things. One, it's an aging society, and number 2, the the number of people, the younger generation that are educated, they usually tend to go work in Tokyo or Osaka. They go into the cities. There's specific words for that in Japanese because it's so common. And then they leave the rest of the market behind and 90% of the other land behind. So from a government standpoint, they want people to buy into older buildings. They want to give tax incentives to the citizens of Japan to invest in older buildings.
Why older buildings?
And again, because they don't appreciate.
Oh, because they don't appreciate.
They just do not appreciate. You go to, for instance, I'll give you an example. People like to go skiing in Hokkaido. Mm-hmm. It's one of the world's premier destinations for skiers and snowboarders. And Hokkaido is a very remote part of Japan. It's nowhere near Tokyo, and it's nowhere near Osaka. It's even further from Osaka. Typical homes there that were built in the 90s and early 2000s, for the most part, around ski towns, have no appreciation whatsoever. So a lot of foreign people like to buy in those areas. You could buy a single family house for $20,000, right?
Oh, yeah, so if we want to run away from New York and have a better life in Japan,
absolutely.
$20,000.
You can buy a whole village for. You can buy a village for $500,000, basically. So,
or in Manhattan, you can get 5 square feet.
That's right.
In some buildings for the same price.
Yeah, for $500,000, you get half a square foot. Yep. Yeah. Or less.
Yeah.
Maybe a quarter square foot if it's 80 Clarkson.
Wow.
So historically, in order for the government to fight that, they actually promote people in Japan, citizens, to buy older buildings so that they can help depreciate some of their tax, your tax obligations. And then what happened is the wealthier population of Japan had realized that this law also applies to international investments if you're a Japanese citizen. So thinking about an old city like London or even New York, obviously London, Europe, they have thousands more years than us, but in the way that the buildings were built, let's just say 100 years ago, you have different types of builds. In New York City, cast iron is very, very popular. And then you also have reinforced concrete and you also have wood. So Japanese buyers can buy, for example, if it's wood, you have 22 years worth of, you get 20% of 22 years, which equates to about 6-7 years, that you can depreciate off of your taxes for the duration of those 6-7 years, or 20% of the wood frame that qualifies as a category of 22 years. If it's reinforced concrete, it's actually even longer. It's about 47 years.
Wow.
So reinforced concrete, you get 20% of 47 years, or close to a decade of time to depreciate it off of your tax liabilities in Japan.
Wow.
So in Japan, like you said, the bond market yields about a 1% or less. You could get 4% in the U.S. Treasury Index in the United States, but if you actually buy real estate here, you have those additional tax savings on top of the cap return rates. And I'm not sure about the commercial world, but in Japan, in the residential world, you're getting about 4.5% in cap rate, net cap gains. So rather than putting it in a treasury index, you could actually get free money in Japan, pay off that 1% loan, maybe 1.5% loan, and then buy property in the United States. And also on top of that, capture the depreciation factors that you can have as an investor.
Wow. I will say I've spoken with hundreds of people about this. This was the most detailed. There's gonna be a lot of people who want to speak to you. So that's the most detailed in terms of like understanding.
No, this is great. If I'm a building owner looking to offload a building, if it doesn't pencil out by American standards, like the Japanese obviously have a much
So last year I sold a dozen properties to Japanese investors. Those are apartment buildings.
Wow. Okay. Yeah. And tying into this question, I'm sure would be, which is my next question. Like, what exactly are they buying? And
It's multifamily properties. They're already renovated. Generally, it's between, again, for the most part, it's $5 to $25 million. They can buy, I don't want to get too granular, but it's wood frame buildings or masonry buildings with wood joists. And they're purchasing the properties all cash. So the closings are in 30 days. There's extensive diligence on the front end that you have to work through. I think a big thing is also just being very friendly and like accommodating, and there's a lot to the dynamic of the interaction as well that I think plays a big role, right? Like
they also demand utmost correctness and accuracy.
Yeah,
it's a Japanese way, right?
Yeah, accuracy. You have to be polite. You can't be pushy. But the relationships that I've built with the advisors from Japan go back 10 years, and I think it's repetitive transactions with it's new buyers, but it's always the same. There's a handful of really, really strong advisors that are here that I've known for a long time. And, so when they have someone that's looking to buy, I generally have a lot of this product and we'll get from point A to point B.
Great. And that's on the commercial side. Talk, what are they buying on the residential side? I assume the same rules apply with the same type of construction of the buildings.
Yeah,
is really the ideal type.
So you raise a good point about townhomes and it depends on the budget. Right. Obviously, not everybody's qualifying to buy apartment buildings like what you were saying.
Right.
We have townhouse buyers that own basically wood frames. That's 22 years of 20% that they can depreciate. But we also have owners that you're also aware of that buy in cast iron or RC, basically concrete buildings. So just to give you an example, if your budget is a little bit lower, not in the hundreds of millions of dollars that you guys deal with, but let's just say you want to buy a one bedroom under $1.5 million, there's a building called the Austin Nichols House, which is the first concrete converted, it's a warehouse concrete, the first actually concrete warehouse that was one of the first concrete warehouses built in New York City in the early 1900s.
Oh, where is it?
It's Williamsburg, on North 4th and Kent Avenue. And that building qualifies for the full maximum 47 years.
Wow.
Of that 20% of those 47 years, almost 10 years of depreciation. So that's a great building. 250 West, you may be aware, Elad Properties converted that building to 1900s cast iron building, converted. So that qualifies for individual buyers if you're looking for something under $5 million. And same with 93 Worth and Tribeca cast iron conversion. That the Japanese government will underwrite the building and they'll say, okay, this building qualifies under depreciation laws.
Perfect. So it makes it a smart investment.
New York is nice. There's a lot of pre-war conversions, as you may be aware, that you've seen throughout New York City. Older buildings, keep the facade, keep the base, keep the look in the windows, but renovate the interior.
Yeah. Understood. All right, we have to take a short break and we'll be right back. When we first started Excel Real Property Management 11 years ago, we did so with the intention of protecting the investment community. Here at Excel Real Property Management, we focus specifically on serving the needs of individual apartments, townhouse, and small multifamily building owners both in Manhattan and select neighborhoods of Brooklyn. Our services encompass everything: rent collection, expense payment, handling maintenance and repair, turnover between tenants, insurance needs. Literally anything that an investor would typically handle him or herself, we take care of for them. Whether you hold one individual apartment or a rental building that houses 20 units, Excel is here to help with all of your specific needs.
Looking to stage a property but on a tight budget and timeline? Stage with Stage and Fold. Stylish, lightweight, foldable, 3D printed cardboard furniture that looks real. Quick delivery and easy assembly. Staging starts at just $199 a month per room, and setup takes less than 30 minutes. Contact us today to stage smarter, sell faster, save thousands with Stage and Fold.
So I want to switch gears a little bit. And, like I said in my opening, over the history of time, it has shown that New York City real estate has always gone up. So over time, it will be a safe investment. I don't know if that is today, tomorrow. We don't know about the ebb of the market, the flow of the market, peaks, valleys. And obviously, there's no shortage of headlines that say that right now New York is struggling a bit. Prices haven't given us much appreciation or even some level of depreciation since 2017. What, in your opinion, is the largest roadblock to New York City real estate appreciating right now? What's causing this kind of downturn in economic, investment in the city?
Sure. I think it's twofold, right? So I think the first would probably be, and I want to back up to think about, everyone talks about politics, right? So, the market boomed, beginning started in 2010 and on, right? And so if we just think about who was in office, stuff like that, you realize that there's micro factors, but the macro factors ended up playing a bigger role there. So when you fast forward to 2019, we had the rent law changes, right? I would say you also have to think, like, as you said, right, markets goes in peaks and troughs, right? So we hit a peak in 2015, 2016. inevitably there's going to be a trough.
Right. There's going to be some level of retraction.
Right. So it did start to fall down. And then you couple that with the rent laws of 2019. And then you had COVID. It just exacerbated what would have already been a likely trough in the market.
Right.
So you saw it prolong. So when it typically maybe would last 5 years, I'm making it up, it's lasted much longer, as we all know.
Right.
And then you had interest rates.
And then that's the crazy thing about the interest rate story. If you look, you even hear Barbara Corcoran, for example, talk about it. And like, I remember back in the 80s and interest rates were, 99% or not 99%,
relative,
but like it was high. And now we're all complaining about 6%.
It's what people got used to. It's relative. And what I think that's good now is for a while, people were almost like offended by it. And now I think it's normalized. And
we had to normalize it, right? We've been in this position for years at this point.
And I think what you had for so many years, and again, I think it's hard to pinpoint, but there was so many different ripple effects from COVID that you can't even point to. That
like that everybody went insane.
Yeah, but ultimately, that creates volatility, and volatility creates inaction, and inaction creates a dead market. What we're seeing now is stability in the market. I think everyone likes to focus on the New York City politics. I can tell you anecdotally, our business skyrocketed after the primary. So I don't think it's played a major role in that regard.
Did you feel that?
Interesting.
Did the residential market, how the
No,
residential
I think
market
what you
react?
said just now is the best word to describe it is stable.
Stable.
So everything's stable.
You're
think
seeing
we have
skyrocketing,
stabilized.
but we're stable on our end.
We are seeing an insane amount of ultra luxury transactions, though. But
Yeah, so on the residential end, you saw New York City reported about a 25 to 30% increase in contracts getting signed 6 months over 6 months. So let's just say like the last 2 months of the year of last year to the last beginning of the 2 months of this year of properties priced over $4 million. So it might be seasonal. It's hard to tell.
Yeah.
But it's also, it's not like the new administration coming in is a surprise to anybody.
Right.
People knew about it. So I think time will tell. We'll probably need maybe a couple more months to really gauge traffic and see what transactions
I am
look
surprised to see the level of activity, though, because I think everybody thought the market would just come to a dead halt. Everybody was going to flee. Remember even back in COVID, people like, everybody's leaving New York and that's it. But it's surprising to see that we do have the volume of transactions.
I think
it's been early. He hasn't impacted policy yet. He hasn't had time.
I think there's, again, going back to the macro element of things, like if you look back at 2010 to 2015 when there was a massive boom, I wouldn't say that we were in a pro property owner environment, right? We were in the opposite.
Yeah.
But you still saw a great uptick. And I think what you usually see with transactions is you need stability first, like you said, stable. And then what ends up happening is transaction volume picks up. And that transaction volume picks up leads to herd mentality. And the herd mentality leads to price increases. A lot of it's emotion as much as it is the actual underlying fundamentals, which are also very strong. I think as it relates to the politics, there's a lot of checks and balances, right? So
you hope there are, right?
Yeah.
And it's actually reassuring to see what's happening with the larger administration of like you try to pass through legislation that like people
property,
don't like, and there is actually still checks and balances in a way that we were worried the guardrails were going to be taken off and it was going to be just mayhem.
Yeah, so as soon as the 9.5% property tax increase was proposed, the next day City Council came out and said that's not happening, right? So
good, because I thought we were only taxing the rich. But I guess it wasn't.
Yeah, no. The
true.
the following day they came out and said we're not going to do that. So.
Okay.
And same thing with COPA. Like this was going to become a thing. Didn't make much sense. Once it ended up making its way through, it was very watered down, and it focused on the right sorts of assets. Like, right, there's good policy if you focus on the right things. It's just when you try to generalize things that it can become a little more complicated.
What do you think about this, Takk?
Well, COPA was great to, I think, have people kind of think about, like real estate transactions and the right of first refusal by NGOs, like that does sound great. Yeah. But then you look at the overall market, I don't know how NGOs are getting the money. People started thinking about, okay, how are NGOs getting the money to bid on properties in the free market against other private capital owners and buyers? And I think it gave a good light for people to really think about the process of how COPA really would impact the market. And I think it's educating the general population, which is a positive.
Right. How much of an impact could it have had, period?
And it ultimately ended up focusing on properties that were heavily rent regulated, in distress, tons of violations, where like, candidly, those buildings, due to unfortunately policy put in place already, they're pretty hopeless. It's a fully depreciating asset. So, to have, if there is a way, again, if there's a path for a nonprofit to come in and stabilize that building, or for owners of that building to be able to participate as equity owners in the building, like, I don't think anyone's against that, as long as it's the right policy that puts in place that doesn't stymie the market and create bigger issues that we don't need to face.
Absolutely. All right, we're going to take another short break, and we'll be right back.
From residential and commercial closings to litigation, Romer DeBoss is your full-service real estate law firm. We blend big firm knowledge with boutique-level attention, delivering outcomes that exceed every expectation. Contact us at romerdeboss.com.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. We work with Brown Harris Stevens and many other top real estate firms, staging their homes to sell quickly and at the highest price possible. Our staging is affordable without sacrificing quality or design. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
Okay, and we're back. So, Takk, I have a question for you. One of the biggest hurdles of the market were the 2019 rent laws. They were incredibly tenant-friendly. Yeah. They're now wrapping us in court if we've got an eviction of 2.5 years, and they really destroyed rent-stabilized values. Of all that legislation, or even outside of that legislation, what hurdles or what barriers need to be removed to jumpstart investment activity?
Wow, the hurdles is a hard question, because the 2019 rent laws, there's probably 20 plus items that affect.
Oh, it was a whole list of
host of not just landlords, but tenants as well. And I'll tell you one thing: I represent about 300 individual co-op condo owners in New York City, meaning like Mr. and Mrs. Smith. They own a one-bedroom condo at 25 Fifth one year, and they moved to Jersey to start a family. People like that. And one thing that is interesting that I've seen since 2019 was it actually positively affected those owners in a way that they had no idea that their rents from 2019, fast forward to 2026, was going to skyrocket. We're talking 10%, 20% year over year increases.
Yeah.
And now not only does that cover the mortgage, the interest, but also plus that. And they have tenants that tend to not want to move because they're looking at, it's like that Spider-Man meme where they're all looking at each other when the leases come up and they're deciding, should I move or not? And let's just say they're not starting a family yet. They're still single, whatever. They don't want to move. Their salaries haven't changed that much.
They thought they were going to buy. They're not ready to buy yet.
That's correct. Correct. They are now looking at each other like this, all tenants, and they're like, wait a minute, I can't move right now because there's nothing available for me.
I'm in the business and I can't move. I'm like, I need to move. Where we live doesn't make sense for our life anymore. I'm like, and I do this every day. And my wife's like, where are we going? I'm like, we're going to renew.
Where are we going to go? Yeah, unless you're making a drastic life change and you're moving to a different city. It's
or
really
Japan.
Or Japan. Or buying a house in Okada. Yeah, there's really not much that you can do as a tenant. So that really positively impacted those unit owners. Now, I also represent owners where they own buildings that you sell, right? They're multifamily, commercial, mixed-use buildings, maybe 10, 20, 30 units, 40 units in those buildings. And every one of those buildings does have a component of rent control and stabilization. And it does make, I got to ask you, it probably shies buyers away when, let's just say 25% of those buildings are rent controlled because obviously, like you said, costs to operate a building only go up.
Yeah.
And the free market does not care about laws initiated by city council and the governors of the city and state. So that really is a pain point, I think. And the biggest loser of the last couple of years since 2019 are really the owners that hold a lot of rent control and stabilized units in their assets that unfortunately they have to keep it vacant. They storage them.
And we don't want that. But the problem is we don't have enough money to renovate. And Brandon can tell us more about this as well. Like the cost that you get back of renovating a unit, I think probably of all the 2019 legislation, there's two things that are hurting us the most. Number one, and this isn't an official law from 2019, but the amount of time that it now takes to get through housing court, that if I have a professional tenant or a bad situation, I'm going to be in court for 2.5 years.
What do you mean by professional tenant? You mean someone that knows the law?
The fraud,
Sophisticated,
that, just waiting for, someone to let them in without running their credit and realizing that they have a 500 score and they have no intention of ever paying you the rent. So that's catastrophic. But the rent stabilized laws are worse because you took an asset and before 2019, it was worth anywhere from 30 to 75 cents on the dollar, depending on the profile of the apartment and the tenant. It's basically effectively worth zero now. And if we don't change this legislation, you're just going to bankrupt the landlord. Like no good will come of this situation. And landlord doesn't want to warehouse apartments. We're dealing with a Japanese family now, and they just bought a building. And they're like, what do we do with the unit? I'm like, if you spend $100,000 in renovations of this apartment, we can take this $1,085 rent and we can raise it to $1,200. And they're like, that makes no financial sense.
You could pay their water and sewer bill. You can pay their gas bill.
And we're going to have you as our tenant for 30 years.
The representation
you can pay
there
taxes on that additional income.
Yeah.
You can deal with repairs and maintenance, or you can leave it vacant and put that money in the stock market and actually make money.
Yeah, and we don't want to warehouse it, but what's our option as a landlord at this point?
So, Brandon, how do you sell those assets? What's the upside on those assets?
So I think the reality is generally as like a threshold number, you generally see people that are interested in buildings that are, I say 70% or more fair market is usually like kind of a sweet spot of like where people are like, okay, like there's enough
cash flow.
There's enough cash flow. There's enough I can do if things go wrong. Like I have, a buffer.
A cushion.
When you start to get above that, what you end up seeing, what's really happening is it's the generational New York City real estate families. So they'll come in, they'll buy these buildings for pennies on the dollar. And for them, they're going to be giving these to their great-grandkids, right? So in their mind, okay, I can get a very high return today because no one wants these buildings.
They're scared.
Yeah, no one wants these buildings. So it's a race to the bottom. And you give it to someone for pennies on the dollar. And in their mind, okay, I got it cheap enough where even if the return is degraded over time, it's still there, right? I give myself enough, again, buffer. And hopefully at one point in time, like things get so bad in New York City that the pendulum swings back.
It will have to change. Look, and I think, I don't know.
People are making a very, very, very long-term bet on the pendulum swing back. Anyone that plans on holding for 5 years, 10 years, even 15 years, they're not going to touch it.
Yeah.
It's too risky. It's, as you said, these are generally the buildings that have the most tenant complaints.
HPD violations.
You got the
inspector coming once a week to write us more violations for nonsense.
Yeah.
But at some point, it's going to shift, right? At some point, you're going to cause so much pain that we're not going to have a choice.
Yeah. Hopefully, it'll shift. Hopefully, the policy will shift to what it should have been the first time around, where it's like you really target bad actors. Because to be clear, there were and are bad actors. I don't want to pretend that there aren't.
There's bad actors and everything.
But there's bad
teachers,
actors
there's bad cops.
Everything. It's a very small minority. And rather than just punish those bad actors, they decided to really go after the industry as a whole, which unfortunately is going to have long-term negative consequences. But look, if you want the programs in the city to support really good things, you need the tax revenue, and right now we'll see over time that tax revenue is not going to be there. Transfer taxes on every single sale, just north of 3%, right? So that's city and state. Mortgage recording taxes, those alone, that's 2.8%. Little things people don't think about, it all adds up. And when you're talking about tens and hundreds of millions of dollars, taxes on those deals, it's pretty significant. And then the income, as the income goes up, usually the tax can go up because it's generally a percentage of your effective gross income. Yep. If that effective gross income isn't going up, again, based on the technical models that they're supposed to be using, you're not going to see the tax revenue go up. So there's so many different things that I think people forget. And also, similarly, when new buildings get built, there's jobs, there's a new building that now you can tax when you were taxing the land at nothing. So there's different And then also, as you mentioned, new supply. At the end of the day, our demand just greatly outweighs the supply. There's no
everybody's
availability.
afraid to build right now.
So, and no one's going to build until New York City becomes more friendly. So yeah, we're in a tough spot. I think, again, with that being said, it's still New York City. So that's the beauty of being a sales broker here, is that there is always demand
To be here.
and to own real estate here. It's just how much is that demand and what price will they pay?
But it's also cyclical. And
Yeah.
Takk, that actually brings me to my next question. I remember last year we had the FAIR Act enacted. Everybody was up in arms. Everybody who is educated about real estate said, we don't want the FAIR Act. It's just going to make things more expensive. And I remember when they first announced the legislation, hey, by the way, the landlord now has to pay the broker fee. We were all up in arms. We're like, we don't have the money to pay the broker fee. And as panicked as we were, the day after the FAIR Act was enacted, Manhattan median rent shot up somewhere between 12 and 15%. Because landlord now has this 8.3% cost. We're going to charge 12, 15% extra to give us a cushion. And it ended up being okay for landlords. It just made it more expensive for us. It made us much more expensive for the tenant. But the silver lining in that was that rent went up and we did make a little bit more money. Not what we wanted, but we did make more money. So, the current administration has been, to say, what's a good term, controversial. And they're threatening us with a lot of taxes and, taxes on this, taxes on that. You're going to pay for the parking, whatever. Nobody got a free bus ride. Do you see any silver linings in the current administration?
It's a difficult and loaded question.
Not that it really controls anything that happens in the actual real estate marketplace, but is there any silver linings that this could be a benefit to all of us?
I think all of us is very tough. In fact, when politicians implement new laws and rules, when it's specifically related to cost, you can't make everybody happy. I think it's impossible.
No.
Right? We all know that, right? Tax systems, fee systems, they're all imbalanced because not everybody's in the same financial circumstances.
Correct.
So let me give you an example. When you said FAIR Act, you know who that really helps?
Who?
And it sounds like a brutal truth. I mean, politicians will probably not like to hear this, but owners like Sol Goldman, BLDG, Pan Am Equities, large owners like Glenwood, New York City.
You did help everyone but the intended person.
You actually made their revenues skyrocket because now everybody must offer an OP to the brokerage community. But now those big landlords, they're no longer offering a full month to brokers anymore. They can get away with offering 75% of a first.
Oh, so they've dropped
month.
their OPs.
So they're now gaining not just a like you said, 8 to 15% increase in revenue on their gross rent margins, but they're also reducing their expenditure on broker fee payments by 25% per unit.
Okay, so that was really a boon for them.
That's a huge boon for them.
I'm not on TikTok. I wish I was.
You're smart.
Yeah,
I'm not on it either.
You wish you can just download it right now.
But if I were to make a TikTok video, I think what I would explain to people with a dance move of some sort is that
one of these.
the challenge you have is, right, we've all been talking about how you renew your lease, right?
Right.
So let's say I'm tenant Joe and I rent my apartment for $3,000 a month and I pay the broker fee. Well, when my renewal comes around, the owner's basing the renewal increase off of $3,000.
Yeah,
correct.
Right. So now I'm Joe and the landlord's paying the broker fee, but I'm renting at $3,500 a month. And all of a sudden my renewal comes around and now my renewal is actually on $3,500 a month, not $3,000.
Right.
So maybe I saved that 1 month, that $3,000 on let's call it on the front end. But now my rent is going off of $500 higher. So in my year 2, if I renew my apartment, 500 times 12, that's $6,000. I actually just lost $3,000 of negotiation power.
Oh, from my perspective, I feel like you're paying the tenant's now paying the broker fee almost twice a year.
It's a perpetuity.
Perpetuity.
And again, unfortunately, the challenge with the real estate community is we're not with the time, right? I'm a good example. I don't have a TikTok. I'm not out there promoting the realities of the world. And I think even if I did, I think people take that with a grain of salt. But that's really going to be the issue. I think the one thing, going back to your question about how can this benefit the real estate market, I think there's 2 ways. I think the first would be We talked about, look, it's sad, but I will tell you, I mentioned my business skyrocketed after the primary. The reason being the amount of people that I've spoken to over the last 10 plus years who were thinking about selling, not very sure. The primary
They just
hit,
want it out. Right?
I got the amount of phone calls that I got. Hey, I'm ready to go.
Yeah.
I'm done. I give up. That was a huge source of business. And if you go back to what I said earlier, right, the way to really see market pricing increase is you need sales volume to increase. So what you saw was there was actually a huge uptick in sales volume towards the second half of the year. And again, if you follow prior cycles, volume picks up first and then pricing follows.
Right.
So there could end up being inevitably like a trickle down effect because there's just more volume, there's more activity, and there's the herd mentality. And then there's the question of, and I don't know, I don't pretend to be smart enough to know the answer to this. You look at San Francisco, which went very much the wrong direction, and it got so bad that it then flipped. And from what I've heard, it's improved drastically under new leadership.
It created opportunity because you put things so low that like it could only go.
Yeah, and new leadership was put in place, and again, I don't pretend to be sophisticated enough to know in terms of that understanding, but from what I understand, it has improved drastically. So I guess maybe one hope is if it does get so bad that people kind of realize what the realities of the world are, and we can then actually finally, instead of just being stuck in limbo with no one happy, we can actually move towards a place where everyone's moving forward.
Absolutely. We can finally be like, okay, maybe this wasn't a good idea. Maybe we need to go back to the problem with life in general is we went far left and far right, and maybe we can all come back together towards the middle, which is where progress actually happens.
Yeah, so that's my only hope. Again, if it gets so bad that it ends up creating commonality amongst both sides to meet somewhere in the middle.
And then it creates opportunity for us young guys.
Yeah.
All right. This has been incredibly insightful. Like, I'm super glad we did this episode.
Yeah.
Thank you so much for watching Managing Manhattan. We'll see you next time.
What do you really need to know about buying or selling a home? First, it's serious business. And it's complicated. There's a lot of money on the table, and emotion too. You need an agent who knows the ropes. So, whether you're buying or selling your home, work with professionals who have a mastery of the craft.